Let's get straight into it and talk about those rate cut calls. We have started to see an adjustment at the front end of the yield curve. Two-year yields pushing higher. How much of an adjustment do you think we need to see in the stock market?
Well, personally, I think for the stock market to become attractive, where the risk reward starts to flip and become really attractive, I think you've got to see somewhere in the neighborhood of 5 to 8% down from today's levels, right? And it's not unusual at all to get those 2 to 3, 8 to 10% corrections intra-year. So I think that's entirely possible. Remember, let me just spin you back for context here. This time last year, the consensus was 85% of economists said we were heading to a recession, and the Fed funds futures curve had 3 interest rate cuts priced in for the back half of 2023. We know those never happened, obviously. Here we sit today, the consensus is this: soft landing, 4 to 5 rate cuts, 10 to 12% earnings growth, and we've slayed the inflation beast. It's not a problem anymore, right? My bet is when we spin forward 12 months and look backwards, that consensus is wrong on a number of those accounts.
A repeat of last year?
I think a repeat in the sense of the Fed just can't give you what the markets want the Fed to give you, right? Which is what if you describe this year to date, it's been pretty boring so far. I mean, the equity markets have drifted a little bit higher. VIX is still low. Gold has not been an issue. Oil prices have not been an issue. It's just been rates, right? We're repricing rates to back out some of those cuts. So I think you've got to see, for us in 2024, you've got to see 3 things happen. If inflation was all the rage in 23, this year it's the labor market, and that in the linchpin to consumer spending. It's earnings, which we need to probably talk about because they're not as good as what I think people think they are. And then it's what the Fed does. Those 3 things are what will determine the path for 2024.